Let's have a check-up on the bond markets now. Sally Old joins us, interest rate strategist from JP Morgan, and also Stephen Nash from FIIG Securities with us here in studio today. Sorry, a quick check on the currencies, which I obviously forgot about. But let's go to our guests in studio with me today. Carson's with us also in studio. Stephen Nash from FIIG Securities, watching those US bonds. A lot of movement, and this is a really big story overnight. Long-dated government bonds really getting a run.
Yeah, I think there's several reasons for that. I think the focus initially was on Japanese GDP, which came in a lot worse than expected. So the focus went back onto Asia. Asia's been the region that I suppose has been holding up expectations of global growth. And I suppose as people start to think about lower growth in Asia, in Japan in particular, maybe there's some anticipation of slower growth in China as well.
Is that so sort of justified though in your view? Because you know the Chinese numbers themselves, a slowdown, a measured slowdown is not the same as a lack of demand, which is seemingly what's happening in Japan.
Yeah.
You know, so.
But I think the problem is for the Chinese that I think, like a lot of people, and particularly a lot of investment banks, we're expecting a V-shaped recovery, and I think the general consensus is moved much more towards a slower recovery, a slower for longer recovery, and particularly in the US now. So that, I suppose, is getting people worried about the prospect of even a further moderation in Chinese growth.
Yeah, and Sally Old from JP Morgan, what's your sense of what's behind the sharp drop in US bond yields, and whether we are seeing the increased chance of a double-dip recession out of that?
Yeah, good morning, Brooke. Well, certainly at JP Morgan, our forecast set doesn't pencil in or doesn't envisage a double-dip recession. I mean, I guess the way our global economists would describe what's going on is sort of like a bounce towards malaise. So we had a really impressive rebound from a very, very deep recession, and we saw some pretty impressive growth numbers over the back half of 2009 and the first half of 2010. But basically, you know, the recovery is losing momentum, and it's a bounce towards malaise. So at best, over the remainder of this year and into 2011, our guys are forecasting that we're going to get something around trend for the global economy. And I think what's playing out in the US is, you know, a couple of things. You know, clearly we had some second-tier data last night, the NAHB survey, the Empire Survey of Manufacturing for the New York district. They were a little bit softer than expected, but you know, really I think there's a fundamental repricing going on, and markets are sort of sitting there saying, you know what, the Fed is now going to be on hold for even longer than we probably anticipated. And in that sort of environment, the trades that do well, and we know this from the Japanese experience over the last decade, are positive carry trades. And so investors are just sort of moving further and further out the yield curve. And that ultimately means that you get a bull flattening of the curve, and the best sort of performance is in that sort of 10, 15, 20, even 30-year sector. So, you know, our guys in rate strategy in the US just in the last couple of weeks have made some pretty drastic forecasts to their yield targets for the US, and you know, we basically see US 10-year yields trading around 2.5% for the next sort of 9 to 12 months.
Yeah, well, the 30-year was the best performer overnight. I mean, in terms of what is that telling you about inflation, Sally, though, broadly speaking, and the Fed's likely reaction as well? You know, it's not good for fixed rate income when you get sort of that thematic of deflation, but how is the Fed viewing it?
Well, Goldman Sachs...
What we saw last week with the Fed was, you know, an acknowledgement that, you know, they weren't prepared to let the size of their balance sheet just sort of shrink by natural attrition, and so hence investing, you know, prepayments and maturities of mortgage-backed securities back into treasuries. And really all that means is that these guys are a lot further away from an exit strategy than anyone really thought. So, you know, as a consequence of what we saw from the Fed last week, we now don't think that the funds rate is going to start moving until probably the middle of 2012, so basically 2 years from now. And I guess in that sort of environment, as a fixed income investor, you're exactly right. You sort of say, well, I'm not going to earn, you know, a lot of coupon or a lot of running return at the front end of the curve, and I have to keep moving further and further out to try and get some carry and some coupon, and maybe, you know, even get some capital gain. And I guess that's why people are moving into the 10-year sector at the moment. But ultimately, you know, you look at a 10-year bond yield, and it's meant to reflect sort of 10-year expectations for growth and inflation. And we know from the tips market that, you know, at the moment 10-year inflation expectations are not even 1%. They're sort of closer to 0.8, 0.9. So it's sort of telling you that we've got inflation of under 1 and growth sort of somewhere between 2, 2.5. So it's a pretty anemic outlook that's priced in for the US over the next 10 years.
Stephen, how's it compare with your forecasts?
We've been focusing on the global implications of the European situation for quite a while, and that's spilling over to global growth. So I think in terms of a house, we've been looking at the global situation, I think a lot more than other domestic economists who've been focusing on the local picture. And I think, that we're seeing probably the lower end of the trading range being developed in the US bond market. You've got 5-year yields, I think it's about 15 points over the GFC low now, which is substantial rally in those securities. And it's saying that people are continuing to roll out. I think at some stage we'll see an end to this, and we'll see a move up in yields. But at this stage, we're basically developing that lower end of the trading range.
And as you've been saying, the implications with all of this is this acceptance that there's just going to be this slower growth rate out of the United States. And I suppose this is maybe why these Japanese GDP numbers that you talked about yesterday are kind of concerning. Yes. You know, the exports, they're slowing. What about the rest of Asia?
Yeah, I think that is the concern. I think that's what happened in terms of markets overnight, that the Asian region was seen as the only bright spot in global growth. Now, if that moderates, then we're in a much lower growth picture going forward.
Is it, Sally, though, I mean, to really sort of look at Japan and see it for what it is, you know, you've got an ageing population there. The comparisons with China are almost, we're not comparing apples with apples. You've got a young, vibrant population there with, you know, the spending power that comes with it, and that's being evidenced already. Do we just sort of cast Japan aside now? What relevance does it have?
Well, it's sort of interesting, I guess, because, I mean, Japan is, you know, one of the world's biggest economies, so it is difficult to sort of cast it aside and say, well, you don't count anymore. And I think the thing that sort of really upset markets yesterday was the fact that the miss relative to expectations was so large. You know, it was sort of, the market was looking for a number around 2.3 and the actual came out at 0.4. That's a very big sort of forecast error when it comes to the GDP number. So I think that's sort of what freaked markets out a little bit. But I guess really, you know, if you look at what's playing out, you've sort of got much weaker than expected growth in Japan, the prospect of very soggy or anemic growth in the US, and I guess an expectation that given the way the US and Japan are performing, the good numbers we've seen out of Europe can't last forever either. So, you know, the G3, which has historically, you know, at least for the last sort of 50 years, been the real driver of the global economy, not looking very, very good, and the outlook not looking particularly good either. So that does put, you know, a lot of the burden on China. And I guess, you know, one of the interesting things which I think bears thinking about is that, you know, people like to sort of say, well, if we're bearish on the US, Europe and Japan, therefore we've got to be bearish on China. But I think, you know, you're right to make a distinction between the two economies. Certainly the demographics are very different. China is an industrialising country as opposed to a developed country, but also, you know, don't forget that it's not a free market open economy. It's still very much a communist economy or country, and that sort of actually has some significant implications, which is pretty much if the Chinese want to run their economy between 8 and 12% in terms of growth levels, they can pretty much achieve that, and they have the measures, whether it be the public sector balance sheet or monetary policy or whatever it might be, to actually achieve that outcome. So I'm not necessarily sure that and the most sort of fruitful way to think about China is to get sort of very negative on its outlook, because I think the story for China for at least the next sort of 3 to 5 years will be that, you know, the growth numbers still come out stronger than expected, given what we're seeing in amongst the developed world.
And as the press was saying this morning, you know, given that China really opened its door to the West just on 30 years ago, it's remarkable that it's vaulted into second spot in that space of time, I mean, all things considered. Stephen.
Can I ask about just on that, I mean, China, that's where we're focusing, and it's certainly where the RBA has been focusing as well. We'll get those minutes out of the RBA today. Are they weighing up the idea of whether we'll have slower growth across the Asia-Pacific region?
Well, I think the RBA is concerned about capacity constraints in the economy looking out 2012-13, but it is constrained right now because of these global concerns, and I think what people will be looking for is how concerned is the RBA about the global situation. So if the minutes express that more than the market is expecting, I suppose that would be positive for bond markets.
In fairness, though, so much water's passed under the bridge since that meeting was held. Is it fair to say that it will be the speech tonight by the governor that will be actually of more relevance? And that's, you know, so we'll have this, you know, fairly dated document to mull, but really we want the latest reality check.
Oh, look, I think yes, to some extent the data is old. Also, I imagine what will be more important than the speech will be the questions. afterwards, as usual.
It's the bit we all really wait for. What about you, Sally? I mean, are we going to get any new information out of these minutes today, or is it completely outdated? Is there any usefulness in it?
Look, I think probably not. I mean, they've already been predated by the quarterly statement on monetary policy, which, was pretty comprehensive in terms of what it contained on the outlook for the global economy and the domestic economy. So in that sense, I sort of think the minutes will pass largely unnoticed. I think the speech tonight, I mean, the speech is on, the topic is the role of finance, so it's difficult to see how relevant that's going to be to near-term policy expectations for markets. And I sort of suspect, given that we're only a couple of days out from a federal election, the RBA governor will be playing a pretty straight bat and not wanting to rock the boat too much. So I don't even know whether we're going to get too much from his speech later on tonight as well.
Sally, why do they hold back on releasing these minutes? Is there not someone taking shorthand in the corner? They can just pretty much release them bang on the decision?
Yeah, it's a good question, Carson. I mean, I guess the way they've sort of structured it is that, you get the outcome and the statement at the beginning of the month, and then 2 weeks later you get the minutes, and then in another 2 weeks' time you get, the next board outcome and statement as well. So maybe the underlying rationale to it is that, effectively they want to sort of spread things out over the course of a 4-week period. But, yeah, I mean, certainly there doesn't seem to be a reason why the minutes couldn't be released, maybe a week after the actual meeting.
Thanks, guys. Sally Old from JP Morgan, appreciate your time, and Stephen Nash with us from FIIG Securities in studio. See you guys soon. Thank you.
Thank you.